Welcome back to Synaptic Dividends. So today, we're taking a look at a true classic, IBM. It's a company that has been a staple in dividend portfolios for, well, decades. But in the tech world we live in today, you've got to ask a critical question.
Is this famous dividend really a rock-solid source of passive income you can count on? Or is it maybe a trap for investors who aren't looking closely enough? Well, to find out, we just have to follow the numbers. And we're going to start with one number that, well, it might make you a little nervous at first glance.
All right, so when you first crack open IBM's financial reports, there is one metric that pretty much jumps off the page and kind of screams, warning. Let's break down what it is.
We're talking about something called the net income payout ratio. All this is, really, is the percentage of a company's official, on-the-books profit that gets paid out to shareholders as dividends. It's usually the first thing you look at. And for IBM, that number is, yeah, take a look for yourself.
It's over 105%. Now just let that sink in for a minute. That means for every dollar of profit the company officially reported, it paid out more than $1 in dividends. I mean, that doesn't sound sustainable at all, right? It's like spending more than your entire paycheck every single month. So yeah, this is the kind of number that can make an investor really, really nervous. But it doesn't tell the whole story.
So, to get to the truth, we need to look past that official accounting profit and instead follow the actual cash, because this is where we find the real story about IBM's dividend.
And the metric that really truly matters for dividend safety is the free cash flow payout ratio. Here's a simple way to think about it. Net income is like your salary on paper, before all the taxes and deductions. But free cash flow, that's the actual money left in your wallet after you've paid all your essential bills. It's the real, spendable cash that the business generates, and that is the money that pays the dividend.
And this just lays it out perfectly. Over on the left, you've got that scary 105% number based on the accounting profit. But on the right, you have the real number, the one based on actual cash, and it's just 50%. So here's the bottom line. IBM is only using half of its actual cash profits to pay that dividend. That's not just safe, that is incredibly comfortable. They have a huge cushion. They could literally pay the dividend twice over with the cash they're bringing in.
So, you're probably asking, why is there such a huge gap between these two numbers? Well, it's basically just accounting noise. See, as IBM has been transforming its business, selling off some divisions and buying new ones, it creates a lot of these non-cash charges on the books. These charges lower the official net income number, but they don't actually affect the company's ability to generate cold hard cash. That dividend is safe because it's paid from the real stuff.
So, okay, the dividend is clearly covered by cash right now, but this kind of discipline isn't anything new for IBM. Not at all. In fact, it's built on an incredible history of rewarding its shareholders, a commitment that goes back decades.
For 30 consecutive years, IBM has increased its dividend. That puts it in a very elite group of companies that we call Dividend Aristocrats. You just don't build a track record like that by accident or by being careless. It shows a really deep, long-term commitment to shareholder returns. Now, what's really fascinating here is the story these numbers tell about the rate of that growth. You can see that 10 years ago, the dividend was growing at a pretty healthy clip, over 4.5% a year. But more recently, it has slowed, way down, to less than 1%. Now, you might see that and think, uh-oh, are they running into trouble? But that's not what's happening. This was a very deliberate choice. Management decided to slow down the dividend hikes to free up more cash to reinvest in the business, so they could double down on growth areas like AI and hybrid cloud.
So, after looking at the cash flow, the history, and the strategy behind the numbers, what's our final verdict? Let's put all the pieces together.
All right, let's get back to our original question. Is the dividend safe? And the numbers give us a very clear yes. The most important metric, that free cash flow payout ratio, is sitting at a super comfortable 50%. And this is all built on that solid 30-year foundation of raising the dividend every single year. So the big takeaway here is you gotta look past those scary surface-level numbers sometimes. The real cash story shows us that IBM's dividend is about as secure as they come.
Now, this was just a quick look at the numbers behind the dividend. If you want to go deeper and understand the why, the business model, the competitive advantages, and the strategy that's driving all these numbers, then check out our full, long-form analysis on our main channel, Synaptic Investing. We'll see you there.